Welcome back. Today is Wednesday, August 19th, 2026, and the market tape delivered three major developments that are reshaping technology, biotechnology, and the bond market. In custom silicon, Google announced a multi-billion-dollar agreement with Marvell Technology to co-develop artificial intelligence chips, triggering a sharp pullback in Broadcom as investors assess custom ASIC multi-sourcing. Meanwhile, healthcare saw a massive single-day move, with Moderna surging 177% after its experimental mRNA cancer vaccine with Merck met its goals in a late-stage melanoma trial. At the same time, the US Treasury stepped directly into the bond market, doubling its liquidity support buyback operations to $4 billion, as 30-year yields tested multi-year highs near 5.33%. Today, we break down what Google's custom chip strategy means for semiconductor margins, the significance of Moderna's clinical breakthrough, and how Treasury liquidity is steadying broader markets. Let's start with the specifics of the Google and Marvell partnership. Marvell issued warrants granting Google the right to acquire up to 58.97 million shares at an exercise price of $206.58. If fully exercised, that represents a potential valuation of approximately $12.18 billion. The agreement ties share vesting to commercial milestones, releasing tranches as Google purchases custom silicon through 2033. Under the partnership, Marvell will develop key components for Google's tensor processing unit ecosystem, including custom inference accelerators, memory interfaces, near-memory computing, and high-speed networking controllers. For Marvell, this solidifies its position as an essential design partner for hyperscale artificial intelligence. For Google, it secures dedicated engineering capacity to scale its proprietary cloud infrastructure. The immediate market reaction was visible in Broadcom, which fell 4.6% as trading got underway. Broadcom has long served as Google's primary design partner for TPU accelerators, with an existing supply arrangement extending through 2031. But today's deal makes it clear that Google is deliberately pursuing a multi-vendor strategy. By bringing in Marvell alongside MediaTek and AMD, Google is expanding its supplier base to prevent bottlenecks and maintain pricing leverage. Analysts point out that Broadcom's near-term revenue remains protected by existing contracts, but the market is reevaluating long-term gross margins across the custom ASIC space. When the largest cloud buyers introduce direct competition into their hardware supply chains, the era of exclusive sole-source pricing power begins to compress. Moving into healthcare, Moderna delivered one of the most explosive single-day moves of the year, surging 177% to close around $174. The catalyst was a major clinical milestone. Moderna and Merck announced that their individualized mRNA cancer vaccine, intismeran autogene, met its primary and secondary endpoints in the Phase 3 INT-ER-PATH-001 trial. Administered alongside Merck's Keytruda in patients with high-risk resected melanoma, the combination showed statistically significant improvements in recurrence-free survival and distant metastasis-free survival compared to Keytruda alone. This marks the first positive Phase 3 result for an mRNA-based cancer vaccine, providing the first late-stage clinical validation for individualized neoantigen therapy. This clinical outcome fundamentally alters Moderna's investment profile. Since peaking in 2021, Moderna's share price had steadily declined as pandemic vaccine demand waned, leaving the company with consecutive years of operating losses. Investors had questioned whether mRNA technology could successfully expand into multi-billion-dollar commercial markets beyond infectious diseases. Today's Phase 3 success answers that question with concrete clinical data. By establishing individualized mRNA as a viable oncology treatment class, Moderna opens up opportunities across multiple tumor types. While full trial data will be presented at an upcoming medical conference, today's announcement prompted analysts to upgrade revenue forecasts, lifting sentiment across the broader biotechnology sector. On the macroeconomic front, the US Treasury took direct action this morning to support liquidity in the government bond market. The Treasury announced that, beginning September 9th, it will double the maximum size of its liquidity support buyback operations from $2 billion to at least $4 billion per operation. These expanded buybacks specifically target longer-dated nominal coupon debt in the 10 to 20-year and 20 to 30-year sectors. With total U.S. national debt nearing $40 trillion and the 30-year Treasury yield climbing past 5.33% earlier in the week, the Treasury is stepping in to ensure orderly secondary market trading and absorb off-the-run supply. The Treasury's intervention comes amid persistent pressure across global sovereign debt. In Japan, benchmark 10-year government bond yields have risen toward 3%, a dramatic shift for a financial system historically anchored near zero. Higher yields in Tokyo alter the economics of the multi-trillion-dollar global carry trade, reducing the incentive for Japanese institutional investors to fund U.S. debt purchases without currency hedging. With German bunds and British gilts also trading near multi-year highs, global capital competition is forcing sovereign borrowers to offer higher term premiums. The Treasury's $4 billion buyback program helps cushion this pressure, easing borrowing costs across credit and equity markets as yields pulled back today. Amid these interest rate headwinds, institutional data reveals an interesting dynamic inside technology valuations. Since January 2025, tech sector equities have gained 65%. Yet over that exact same timeframe, the sector's forward price-to-earnings multiple has actually compressed from 29 down to 22. This multiple compression occurred because corporate earnings growth expanded even faster than share prices. Rather than trading on pure speculative multiple expansion, large-cap technology valuations are being anchored by real cash generation and balance sheet strength. This earnings cushion explains why tech leadership has remained resilient, even as 30-year bond yields tested 19-year highs. Furthermore, market participation is no longer confined to a handful of mega-cap leaders. Over the past week, fresh all-time highs were recorded across the S&P 500 Equal Weight Index, U.S. mid-caps, small-caps, and broad European benchmarks. This broadening breadth indicates that corporate earnings strength is diffusing across industrials, financials, and regional cyclicals. While concentrated mega-cap rallies often signal late-cycle exhaustion, broad-based participation suggests that institutional capital is actively seeking value and growth across multiple market segments, providing a sturdier foundation for the overall market. For active growth investors, Investors Business Daily announced significant updates to its proprietary rating system today. The revamped methodology adjusts how growth metrics are calculated under the CAN-SLIM framework. First, the EPS rating now places heavier weight on the 3 most recent quarters, up from 2 quarters previously, to better capture recent operating momentum. Second, the relative strength rating incorporates additional smoothing variables to reduce volatility caused by expiring price gaps from a year ago. Finally, the screening universe now removes illiquid penny stocks to ensure cleaner comparative rankings. For traders screening for market leaders, these adjustments provide a more refined institutional-grade filter. While broad market breadth is expanding, select consumer names continue to face severe operational headwinds. Nike is currently trading near 10-year valuation lows, with its dividend yield hovering near 4%. However, fundamental analysis shows that Nike's free cash flow payout ratio reached 110% in fiscal 2026, meaning its current cash generation does not fully cover dividend distributions. Management has withheld full fiscal 2027 guidance due to near-term uncertainty, while fourth-quarter revenue in China dropped 17% currency neutral. For income investors, this illustrates why high yields require careful balance sheet inspection to avoid value traps in restructuring retail names. In the industrial sector, credit rating sensitivity remains a focal point for Boeing. Boeing's credit rating currently sits at BBB- from S&P and Baa3 from Moody's, placing it just one notch above speculative grade on a debt burden of approximately $55 billion. A downgrade to high-yield status would trigger mandatory selling from investment-grade funds and significantly raise debt refinancing costs. On the other hand, Boeing maintains a commercial order backlog exceeding $700 billion, which provides substantial long-term collateral for credit markets. Boeing's task remains stabilizing manufacturing cash flows to protect its investment-grade status before major debt maturities come due. Bringing everything together, today's market offers 3 practical takeaways for risk management. First, Google's warrant deal with Marvell demonstrates that hyperscalers are actively diversifying custom AI hardware, creating selective opportunities across ASIC designers while compressing sole-source margins. Second, Moderna's clinical breakthrough proves that mRNA oncology is transitioning into a viable drug class, warranting renewed attention to high-quality biotechnology clinical programs. Finally, the Treasury's $4 billion buyback program provides essential liquidity support at the long end of the yield curve, keeping borrowing costs manageable. Focus on companies with genuine cash flow growth, monitor long-term yield behavior, and maintain discipline across your portfolio. Stay sharp, manage your risk, and we will see you tomorrow.